until now, there's been presentations done intraday. My discussion or presentation is mostly going to be for the longer investment horizons, and more specifically I'm going to focus on what information you can extract from news aggregation. The data set that I'm using, I'm basically looking at two different data sets. Both of them are RavenPack news analytics data sets. One is focusing on our companies' entities, or whether entities are companies. The other one focuses on our new global macro product. I look at an historical archive going back to 2000, and my different studies that I do utilizes about 500 equity type events and around 900 type of what we call market moving events on the global macro side. We offer, as part of our product, a number of different sentiment analytics. Most of the studies that have been done, or most of the results presented in this presentation, is based on our event sentiment score. We typically find that focusing on the most relevant information about companies, that is where the companies have played a target role in an event, will significantly improve the risk-return trade-offs of your model. In a paper that we just released today, and which you should see in your inbox when you get back to your desk, we found that, for instance, on a weekly investment horizon, your information ratios were about 60% better if you focus on relevance 100 stories, where you have events, as compared to, let's say, relevance 90 stories, where you go for more, you can say, of the standard measures of sentiment, looking at positive and negative language, etc., in proprietary dictionaries. Some of the other analytics that I utilize is our event novelty score, so basically being able to filter on the most new and novel news about companies, and that obviously also has some impact. As part of my presentation, I'm first going to go through some basic characteristics that are good to know about news data, especially when you start aggregating it, to kind of trying to understand the different potential biases that there are, the different, in this case, seasonal patterns that you see in news. And some of the things that you definitely see is strong seasonal patterns, and here I present some of the more important ones. So this is, can you say, an intraday pattern that you typically observe. So it's basically in UTC time, but typically you tend to see, can you say, news clustering around the opening and closing of the European, Asian, European, US trading sessions. And typically you see that the pattern is very similar to what you see for the intraday volatility patterns. This is based on our equities package. For macro, you tend to see a slightly different, or quite different pattern. More events are pushed early in the day. Typically you have economic releases being released, can you say, pre-US market. So you kind of have more of a skew towards early in the day. If we look at the weekly pattern, we typically see that most news comes midweek, where Thursday is the, can you say, the most news heavy day, and obviously you see a weekend effect, so less news during weekends. Similar type of pattern is shown for macro news. I will say it's more evenly distributed during the week, but you definitely see the weekend pattern again. If we look, typically when you look at news, you tend to see a quite heavy positive sentiment bias, especially for equities-based news. So one of the things to take away from this picture is that the green bars is equities news, and the gray bars is macro news. All of the green bars, so looking through the business week, or the week, you see all bars are above 1. And on Mondays, where you have the strongest positive sentiment bias, you have more of a 2-to-1 relationship. But as you can see, it drops during the week. And basically, you typically see that companies tend to release more bad news either on Fridays or during weekends. Not surprising, but it's nice to see that as well showing up in the data. If you look for macro news, you tend to see there's no real bias, but you definitely see more negative news during weekends. One of the other interesting things that you see looking at these type of data sets is that the media tends to dwell on negative news. And we show that by looking at the average, or can you say the ratio, the count of positive stories divided by the count of negative stories, down our conditioning on our ENS scores, our novelty scores. So we basically look at, over here, the most novel news, so novelty 100 means it's the first time we have identified can you say the company playing a specific role in an event. And 0 is the least novel, so you've had a lot of coverage of that particular event. And as you can see, the average, or the sentiment, the sentiment ratio, as we call it, has less of a positive bias as you go through the novelty chain, and it actually turns into a negative bias for the least novel news. There has been some academic studies out there, or at least one, that kind of looks through this, can you say, negative bias down the novelty chain. And one of the findings that they had in this study was that it's actually a pretty good predictor of future volatility. So those stories tend to get a lot of media coverage and have negative sentiment around them. Typically will result in high levels of future volatility. One of the other things that is important to take into consideration is that there's a high correlation between size and news flow. Again, it's not surprising, but you know, and it's one of those basic facts that are nice to know when you start to aggregate information and you kind of compare your scores across a certain universe. Obviously, you need to figure out, do I need to normalize for news flow, and how should that be done? This is a study done by Macquarie, where they looked at the Russell 3000 companies, and they found a pretty strong relationship between market cap and news flow. It's not perfect, the relationship, obviously, and one of the reasons why it's not perfect is that there are also differences across industries. So you have both a market cap effect and an industry effect, and then of course there could also be some company-specific company-specific elements driving it as well, such as let's call it the sexiness of the product line. Apple tends to get a lot of focus, for instance, as compared to other companies perhaps in the same industry. You can't say of the same size because there are not that many of that size. But here we just look at, can you say, the average number of stories per month per company by different industries. And as you can see here, telecommunication companies tend to have the most news, and about twice as much news on average than you do see for basic materials. I will say probably here Apple is making up a big chunk of that. Typically what we see is that over time that technology and financials tend to have a lot of news, but you can definitely see shifts over time. We did a study where we just focused in on the top 1,000 most, what we call news liquid companies, so those with the most novel news about them within a certain time period. We focused in on that and looked at how the industry composition changed over time. And very interestingly, we found that back in 2000, you had a lot of very news liquid companies belonging to the tech sector. But it started to drop. So you kind of had the high around 2000, and then you saw a drop going into, let's say, 2003. In 2006, you saw already financials becoming the most news liquid sector out there, or the sector with the most news liquid. It seemed to max out around 2009, after which, can you say, the number of news liquid companies started to drop again. And more recently, you have seen technology take over again as the most news liquid industry. We didn't, can you say, move further down that path, but I think it's an interesting pattern, and it might be interesting input to see, are there certain are risk levels shifting generally in the market from one sector to another. Tracking, can you say, news liquidity or the composition of the most news liquid companies might be an indication of such shifts in risk. This kind of leads us into some of the more, some of the research that has been done. Some of it has been done by ourselves. Some of the research has been done by third parties. But here are some, can you say, of the key messages. I've decided to focus on 6. There are obviously more messages to take away from some of these studies, but I think these are some of the more important ones. Typically, we tend to find that negative sentiment has a greater impact on prices than positive sentiment. And here's a simple example of that. This is kind of an event study, so it's actually one of the few pages that show that it's not based on some level of aggregation. But I kind of said that's okay. I wanted to can you say, convey a message, and I think that this one does it well. So Macquarie again basically looked at stories that we classified as being negative to a company. Again, the universe was the Russell 3000. Basically, they found a negative drift going into the event. Here's 60 days pre-event, 60 days post-event. So a negative drift going into the event. I argue some of that is caused by clustering. So negative news tends to follow negative news, and that kind of already sets up sets the company onto a negative return path. A couple of examples of that is that if you focus, let's say, on actual events, so a layoff event or a bankruptcy event, those tend not to be the first times you see a negative event on the company. So you tend to have some pretty strong negative return drifts going into the events. And that's part of what you see here. They found a sharp drop intraday, a 5-day reversal, which they argue is due to short coverage, and then they saw a negative drift days and weeks out. One of the other things that I find interesting about this picture is that you tend to see, can you say, a greater spread to the market than you see to the sector, which is the blue line. And that kind of indicates that there are also spillover effects between related companies. Even though you haven't got news every single day, it doesn't mean on every single company, it doesn't mean you can't make decisions based on news. You may just make decisions based on related companies. But I think in order to, can you say, drive home the conclusion of negative news being more impactful than positive news, we tend to see here that that's on the market, exit to the market, you have about 1.5%. But if we look at a similar picture for positive news, again, positive drift going into the event, sharp increase intraday, continued drift for days and weeks out, but a more muted effect. So here it's only 0.5%. And there doesn't seem to be a lot of spillover effects. This is just, can you say, one of the asymmetries you see in news, or actually 2 of the asymmetries you tend to see in news. So negative news, stronger spillover effects again for negative news, but there are lots of asymmetries in news type data. One of the other ones is that negative sentiment tends to decay more slowly than positive sentiment. So in this case, we constructed a sentiment indicator, so aggregated over a certain time horizon, and looked for changes in sentiment at the company level. Whenever there was a, can you say, a certain change, we would classify that as either a positive or a negative event or trading opportunity. And this was kind of the pattern that we saw looking at up to 5 days out. So first of all, it's noticeable that there is a positive spread between the positive and negative companies. And you also see that those companies where we didn't see a sentiment change, well, there didn't seem to be any pricing desire on average. But another thing was that if you look on the positive side, we found that the impact seemed to be statistically significant on a 2-day horizon, but on the negative side, it was 5 days. But obviously, in both cases, most of the performance, or most of the impact, was on seen intraday, as well as on day 1 and 2. One of the other things that we luckily also find is that sentiment trends impact financial markets, and I'll show a few examples of how few different studies in different ways how it could impact. So in this particular graph, we basically looked at both our equities package and our new global macro package and aggregated up to the market level, or really we aggregated up to global sentiment indices and related that to MSCI World. We aggregated, we basically just counted the number of positive stories or events minus the count of negative events over a 3-month window. And this is basically what we found. So the blue line represents the global sentiment index based on global macro news. The red line represents the index we constructed based on looking at company-specific news and aggregating bottom up. And finally, the green line represents the MSCI World. First of all, it's quite striking to see how they actually behave. They behave quite similarly. If you look at, can you say, the larger trends. So even though it's completely different sets of data, okay, it's both news data, but one is focusing on companies and the other one on global macro. But you kind of still see some underlying trend forming, which is quite interesting. And in fact, we found a 53% correlation between the global macro and the equities indices. But there definitely seems to be some value potentially in tracking both indices and understanding perhaps how the markets are impacted, can you say, dynamically by either macro news or equities news, as it may change over time. That in certain environments, macro news might matter more, while in other environments, equities-based news might matter more. The next couple of studies that I'm going to show kind of jumps off from the idea of constructing market-level sentiment indices. The next one, the first one I'm showing, looks at predicting if we can use this type of information to predict macroeconomic indicators. And the other study tries to relate market-level sentiment to individual companies, trying to understand if different companies are driven differently by market-level sentiment over time, and see if we can extract value from that.
The equities used in this chart, what is the set of equities indices covered?
This is basically looking at this is a global universe as well, so it's looking across the 30,000 companies that we cover, and it's news weighted, so it's not market cap weighted. This is kind of just an overview of the result we found doing, can you say, a relatively simple study on trying to predict GDP. So first of all, we created a benchmark model. Oops, wrong. So these are basically the results of the benchmark model. We left out the parameter estimates, otherwise it couldn't quite fit. But we include, can you say, more traditional factors in there. So production and non-supervisory employees numbers, housing starts, and industrial production index. Then we added our macro sentiment index. We tested it across different aggregation windows, so aggregating news over a 3-month window, 6-month window, and 12-month window. And basically what we found was that adjusted R squared, bringing in, can you say, up to 4 lags of global sentiment, global macro sentiment, we found that the adjusted R squared significantly improved. So in fact, it's not quite 50%, but it's a quite dramatic improvement that you see in adjusted R squared. We also found that the model fit became even more highly significant. It was already pretty good fit, but you definitely see an improvement. Bringing in market level sentiment. We also found quite interestingly, that all of the lags, first order lags, seem to be highly significant, at least at a 5% level. And all negative parameter estimates that we got were insignificant. We tried as a benchmark to see, okay, could we have gotten a view on sentiment to the University of Michigan Consumer Confidence Index and tried to put that in. And we just found that, basically found that it didn't really add value to the model. So it seems as if we are, can you say, or our sentiment index, or the one we constructed based on data, seems to have value in there that isn't captured by this alternative measure of sentiment. Yeah.
Do you know how this compares to analyst consensus?
We haven't tried to test that. That would obviously be interesting, and a different source of sentiment. The other study that we did was more on the equity side. We constructed a US market sentiment index and tried to relate that to individual stocks. We look across a pretty big universe. I think it was something like around 6,000 companies in the US. What we did was we introduced the concept of news beta. So we basically set up a multi-factor model, included, can you say, some of the more traditional factors. So we had traditional beta, size, value, and momentum, and then we introduced the fifth factor, which was changes in our market level sentiment index. One of the first things that we found was that news data held relatively low correlation, or actually low correlation, to more traditional factors. So we found over the entire period that correlation was less than 5%. Of course, that can change over time if you look at more about dynamic correlation measure. The other thing that we found was, which is, you say, more in support of this first finding, was that if you look across the news data deciles, we found that, first of all, those stocks that seemed most responsive to traditional factors also seemed most responsive to market level sentiment. But you could be a high news beta stock, but be either a positive or negative. So it did seem as if it brought an additional dimension to it. What we're showing in this picture is basically the performance across, can you say, the forward or future performance of companies that fall into the different news beta deciles. So here it's with a 1-month investment horizon going up to 12-month investment horizons. And what we found was that the signal seemed to be strongest, statistically significant, from with a 6 to 12-month investment horizon. But you already saw, can you say, the same intuitive spreads, or the same positive spreads, already at the shorter horizons. But it seems as if a signal like this is incorporated very slowly into prices. But what we found was that negative news beta stocks, which you see in this end here, significantly outperform positive news beta stocks consistently over time. In terms of the economic interpretation of that, well, when you're in a bullish sentiment environment, those stocks that haven't been impacted by this bullishness tend to go through a catch-up period and will outperform over the following time horizon. But when you're in a bearish sentiment environment, those stocks that haven't been impacted by this bearishness tend to continue outperforming. We did find two distinct periods where this relationship seemed to break down, but it wasn't something we tried to solve in any way or address in any way. But interestingly, just from a, can you say, casual observation point of view, we found that the signal or this relationship seemed to revert, or not revert, but be reversed around market lows. So around, can you say, the bottom after the .com bubble, and again in early 2009, you saw about a couple of months before the market turn and a couple of months after the market turn, the relationship was the opposite. But overall, can you say, if you ignored that and just traded negative news beta stocks all the time, and long and positive news beta stocks short, you would have arrived on, the strategy would have delivered something like an information ratio of 1.3, 1.4. Yeah.
What's the US price?
This is the US market, basically. We looked across 6,000 companies.
And the news index is an aggregate sentiment index?
Yes, aggregate sentiment built bottom up on news on all US companies as well.
Updates daily?
Sorry?
With daily updates?
Yes, daily updates. The newspapers were estimated based on a rolling regression, looking at 252 daily data points. The investment decision was made, in this case, monthly with the strategy, but and with the basic assumption that you allocate 12 to your portfolio every month, and then hold it for 1 year. From it, but I want to, can you say, keep related to a different message. So we've already talked about that. The other thing that we have done, and this is actually a paper that you should have available in your inbox when you get back. We took a similar type of approach to company-specific sentiment. So in this case, for this study, we aggregate sentiment at the company level. Again, or we focus in this case on the sentiment trend on a company over the past month, subtracted the sentiment, average sentiment over the average daily sentiment over the past 6 months, in order to adjust for effects that were related to what's normal for this type of company, given its industry it belongs to and market cap. So we didn't, can you say, control in a cross-sectional way, but more from a time series type approach. And finally, we divided by the standard deviation of the data sentiment scores we got for the companies over the past month, in order to favor those companies that have had the strongest recent sentiment conviction. And this is basically what we got in terms of performance. If we looked across the different sentiment deciles. Again, this study was based on about 6,000 US companies. So typically what we find is that we see two interesting patterns. First of all, we find a momentum effect, and we seem to find a reversal effect as well. But one of the things that we found to be very interesting here was that if you want to trade the momentum effect, at least with this signal, the type of indicator we can start with here, you actually don't want to go long the most positive sentiment stocks. You want to go long the more mildly positive sentiment stocks. But you do want to go short the most negative sentiment stocks. And the reason why you want to move in and go, can you say, long the mildly positive sentiment stocks is because there tends to be an overreaction to extreme positive sentiment. And therefore, you see more of a reversal effect at this end. And in fact, we found both of these to be statistically significant. Typically, we found this, by the way, this picture is based on 1 month excess returns. But this pattern, or can you say the momentum effect, when you look across size, tends to be strongest over the 1 week horizon, while the reversal effect is definitely stronger over the 1 month horizon. It might look like that there was a reversal here as well, but there isn't. Well, at least it's not statistically significant. But there are other characteristics we believe that could explain this short dip. Yeah.
Is the reversal only for the delta 10? Because only for delta 10 is negative.
We definitely find it.
Just like 8, 9 is still positive, so you still want to bet as a momentum, right? You want to go long.
Basically, our long, the strategies that we work with go short, sentiment deciles 1, 2, and 3, and long 6, 7, 8. Then we ignore 9, but short 10 in the reversal way. So 9 is ignored. And the reason is it's not as consistent. We get pretty consistent results across size with this pattern. But size decile 9 is a little bit less, it seems less robust in terms of the results. So we just ignore it. But we didn't, just to finish this up, we didn't find any significant reversal effect here. Take out a little bit later, but since we find that sentiment typically, but again depending on the type of indicator you construct, but typically you find sentiment to be stronger for the mid-cap, small-cap universe than for the large-cap universe. Well, if you have an overweight of large caps here, well, of course you will see a slightly less, slightly lower reaction on this sentiment as well. So I've already started, you say, talking about this a little bit. We find that sentiment impact differs across size. So in this case here, this is actually relating to the news beta study that we did. And interestingly, we found that it actually worked better, or had a stronger predictive power for large cap than for small caps. So we actually end up, so the information ratio that I mentioned before of 1.4 was actually based on a value-weighted strategy and not an equal-weighted strategy. So you see it's quite a big difference you see for the largest companies as for the smallest. In fact, for the smallest of companies, it's almost the reverse relationship that you see. For the company-specific study that we just went through, we find somewhat of an opposite pattern. So if you look across, so up here you have the 1 week investment horizon, down here you have the 1 month investment horizon. If we look at the information ratio, we find if we ignore size SR1, it doesn't seem to work for the smallest of companies, which we believe is caused by simply too little news being available. We calculate, can you say, sentiment volatilities, etc., and it's very difficult, and you might not get very good estimates of that with 3 data points. So for size SR1, it didn't really work well, but otherwise you see that as you go through this size SRs, that information ratio drops. You see a signal turnover or portfolio turnover decreasing. Well, it comes at a trade-off that you actually get a less interesting or not as strong information ratio. But you definitely see that the trade-off between, or that trade-off is less for small mid-cap range, but it's definitely pretty penalizing when you start to move into large caps. The other thing that we also found was that there also seemed to be a greater trade-off between value and equal weighted for large than for small caps. So here we basically see that for small caps, moving from an equal weighted approach to a value weighted approach, the information ratio for these portfolios tends to drop, or these strategies tends to drop, 50%. But for the large cap universe, it's almost a 50% drop. Obviously, you can start to put maximum weight constraints, etc., and that might be something that is recommended on the large cap portfolio, and that should help you a little bit in that respect. But you definitely see a bigger trade-off on that. So the last thing I want to say before I open up for additional questions, if there are any, is that media attention, that is where you count or look for when companies have abnormal news about them. So you basically do not look at the direction of news, but just the abnormality of news. There also seem to be some information in terms of company mispricing. So these studies are actually done by McWhorter, and they basically look at 12-month momentum, strong, neutral, and weak momentum across, and they did 2 types of studies. So they basically said, how do you come up with a proxy for attention? One is media attention, the other one is trading volume. And then they compared the 2, which one seemed to be the stronger one. So first of all, they found that stocks with high momentum, but below average news media attention, I think actually it's the wrong one. I put both of them up. So stocks with high momentum, that's here, and below average media attention, they tend to outperform. So basically, they say this suggests that the stock prices have been neglected by investor inattention, and therefore there may be information embedded in the trading price that investors have missed. But when you look at can you say, stocks with poor momentum, but high media attention, they also tend to outperform. And here, they suggest it's an overreaction to poor news, and therefore stocks are undershoot, leading to stronger future performance once the news dies down. And interestingly, they didn't find, can you say, in fact here they found the opposite pattern on looking at volume, and it definitely wasn't as strong. Another way they also did a different study where they looked at media attention, and that's going to be my last point. This was done based on across 10 Asian economies and ex-Japan. They looked at a media attention indicator, looked at different aggregation windows. So it's all of them are based on the same investment horizon, but based on different aggregation windows and coming up with their media attention measure. And compare that to a standard momentum indicator factor as well. And what they find is, first of all, that companies that have had a lot of abnormal media coverage or media attention, short-term media attention, tend to have overreacted to that. So similar to what I found in my company specific study. They tend to underperform over the following time period. But if a company has had, can you say, consistent or persistent media attention, it actually turns into, there tends to be an underreaction, and they tend to outperform over the following time period. So working with media attention and basically ignoring sentiment direction can also be interesting. And as a final note to that, we find even that when you bring sentiment into the mix, sentiment interpretation tends also to be different depending on whether you're in the media spotlight or out of the media spotlight. So if you're in the media spotlight and you have had sentiment that moved with the market, you tend to have overreacted to that. Likewise, if you have had abnormal media attention and you had negative sentiment that also moved with the market, you also tend to have overreacted. While the interpretation of sentiment is much more stylized when you look at companies that are out of, haven't got that same media attention. That was it. Any questions? Yeah.
You showed a chart earlier, the asymmetry of the signal decays, positive news versus negative news. And how would you contrast that to traditional post-earnings announcement curves? Because it looked very similar to post-earnings announcement curves, the pattern. And a lot of that news probably has to do with earnings, but is there any, how would you differentiate that versus earnings news versus other type?
In this particular signal, we didn't differentiate, but it's definitely possible to construct signals, for instance, that ignores earnings if you don't want that. We categorize the different events, so we have on the equity side about 520, and those you can bucket in many different ways. So you can say, okay, I don't want scheduled news, so you can say scheduled versus unscheduled. You can look at hard versus soft information and how that is incorporated, or events that tend to be more explanatory than predicted. For instance, we have an event which is just called stock loss, stock gain, which is obviously looking more at what has happened rather than what will happen. So it is possible to, can you say, filter on whatever information you're interested in. Any other questions?
Thank you, Peter.